Hello, friends. Welcome to Financial Peanuts in the Warren Buffett Stock Selection Strategies series, which is part two. In this video, we're going to talk about how do you analyze um, stocks as far as the stocks returns are concerned, and how would that help you choosing a stock. Now, to know your to know what sort of returns you would be making on the company that you've chosen or the stock that you've chosen, we need to understand a ratio, a very famous ratio, which is called as the PE ratio, which is nothing but the price to earnings ratio. In simple words, it's the current market price upon the earnings per share. So, as a long-term stock market investor, why would you want to put your money into a company which will not give you any returns on the principal amount that you've deployed into the company once buying the company? That brings us to the next question: how would the PE ratio help you find such a company? Now, the PE ratio alone cannot be used to find such wonderful companies that would appreciate your capital over the long term, but it is definitely one of those tools which would help you find one and help you grow your wealth. So, to understand the P ratio, we show you an example over here in which you have two companies, company A with a P ratio of 25 and company B with a P ratio of 5. So what is the meaning of this? Now, in simple words, if you can, if you can just recite after me, that would make things much easier. So let's start. Company A, for every 25 rupees you put into buying the company or the stock, the company earns 1 rupee for you. Well, that's not a very good idea. For most of you watching this video would also agree to what I'm saying. And we have company B, in which company B, for every 5 rupees that you put into buying the company or the stock, the company earns you rupees 1, which is still fine as compared to company A. Now in this chart, this chart simplifies the connection between the P ratio and the returns you would get out of the company. So for a P ratio of 25, you get a return of 4%, which is very poor. And as you go down the chart, you would see that your returns are increasing. For a P of 20, you would get a CAGR of 5%, 15, 6.6, 10, 10%, 5, 20%. So your basic goal would be to search companies that have a P of 15 or lower than 15, as Warren Buffett does. A few words of caution before using P as an analytical tool to judge stocks is that do not compare sectors using P ratio. Now, this can be explained with an example that the utility companies, for example, the power generation companies, generating companies, have a low P ratio. Another example of this would be the oil marketing companies versus the FMCG companies that usually command a high P ratio. So that does not mean that the FMCG companies are not worth putting your money in because they are currently at a very high P ratio. Yeah, you would want to buy them at a very reasonable price because but this you would do whilst comparing the average sector P, not the sector P with other sectors. So in this case, we've shown you a few examples of utility companies such as NTPC, NHPC and Power Grid, which are basically power generating companies. And as you can see that for NTPC it's 8, for NHPC it's around 7.24, and for Power Grid it's 8.4. Whereas for the FMCG sector, you would see that Hindustan Unilever or HUL is trading at a PE of 69.5, almost 70. Marico is almost 45. Britannia is 60. So the take-home peanut in this case would be that the PE ratio is an important analytical tool that helps you select a stock that deserves your attention for investment, but you should be cautious while using it whilst comparing different sectors. And of course, returns matter, because you would never want to put your money into a company that does not earn something for you. So I hope you like this video. We're gonna come up with part 3 very soon, in which which is the final part of this series, in which we talk about Warren Buffett's sort of a condensed analytical tool which combines all these various ratios, such as the price book ratio, the price earnings ratio, and it gives you a very simplified tools in which you can find companies that are worthy of putting your money into. So thanks once again for watching the video, and if you like the video, press the like button and also subscribe to our channel. Thank you.